When a company releases an earnings report, you kind of expect the basic physics of Wall Street to hold up, right?
Right.
Like if the internal numbers are terrible, stock drops.
Right. Exactly.
And if the numbers are fantastic, well, the stock pops. It's just cause and effect. But then you look at what happened with Pinterest on August 6, 2026, and gravity just entirely stops working.
Yeah, it completely disconnects from reality.
Totally. I mean, we're looking at a scenario where a company reported absolutely record-breaking user numbers. They completely smashed their earnings expectations, and the market instantly punished them with a nearly 9% plunge.
It's just a brutal reaction. I mean, for anyone watching their portfolio, it feels, entirely backwards. You see green across the board on the balance sheet, but the ticker is just bleeding red.
Okay, let's unpack this, because our mission today is to cut through the immediate noise of this Q2 2026 equity research report and really figure out why Wall Street is reacting so violently to seemingly stellar news.
Yeah, there is definitely a lot beneath the surface there.
Right. So we're going to break down the collapsing unit economics going on behind the scenes.
Yeah.
Ultimately, we're going to explore this massive existential question hovering over the platform. Like, is a $4 billion bet on artificial intelligence going to save Pinterest? Or is generative AI the exact thing that will destroy it?
It is honestly the perfect modern tech case study. To understand the market's reaction here, we really have to separate the headline vanity metrics from the underlying structural realities of the digital ad business.
Well, let's start with those vanity metrics because, I mean, they genuinely are phenomenal. For Q2 2026, revenue was up 18% year over year. They hit $1.18 billion.
Which is huge.
Right. And then you look at adjusted earnings. Analysts had modeled for about $270 million, and Pinterest came in and just crushed that with $311 million.
That is a massive beat, generating $40 million more than the street projected. I mean, that shows real operational leverage in the immediate term.
Yeah, and the user base is just staggering. Monthly active users, or MAUs, hit 640 million. That's up 11% year over year.
It's a huge audience.
It really is. You have hundreds of millions of people logging on, discovering things, pinning recipes, planning weddings. But despite checking like every single box for a successful quarter, the stock traded down $2.22 in a single day.
An 8.68% wipeout.
Exactly. It completely derailed a multi-week recovery trend. And, I was looking at management's notes, and the headwinds they cited for Q3 feel almost like, I don't know, temporary excuses. They've blamed things like shifting Amazon Prime Day and the World Cup.
Well, yeah, they sound like minor calendar quirks. But in the digital advertising ecosystem, they act as massive structural drags. I mean, markets are entirely forward-looking.
Right.
The 9% drop wasn't a reaction to the Q2 beat. It was a reaction to the Q3 guidance, which management set between $1.19 billion and $1.21 billion.
Which was a letdown for Wall Street.
Exactly. Investors were modeling for a rapid acceleration in growth, but instead, management signaled deceleration. And those quote-unquote excuses actually illustrate how fragile ad revenues can be.
So let's dig into the mechanics of that. Because how does Amazon Prime Day moving on the calendar actually hurt Pinterest's revenue?
It really comes down to how major retailers allocate their quarterly marketing budgets. It's largely a zero-sum game,
Okay, so they only have so much to spend.
Right. When Amazon shifted Prime Day from Q3 last year into Q2 this year, massive advertisers, brands selling consumer electronics, apparel, home goods, they basically picked up their Q3 ad dollars and pulled them forward into Q2 to capitalize on that event traffic.
Oh, wow. So it creates a temporary surge in Q2, which Pinterest obviously benefited from.
Yeah.
But it leaves this massive void in Q3.
Exactly. Management noted that shift alone creates about a half-point headwind for the coming quarter. It literally cannibalized their own future revenue.
And I assume the World Cup dynamic is a pretty similar story. They had a massive influx of brand awareness spending last year that simply doesn't exist this year.
Precisely. The World Cup gave them nearly a full point of benefit last year. So when you strip away the noise of those one-off events and look at the business on a purely organic basis, their growth is actually decelerating significantly.
Which is never what you want to see.
No, not at all. It's slowing down from 17% year-over-year growth to just 13%.
But, those 640 million users aren't worth much if the underlying unit economics are collapsing. Which brings us to the real reason Wall Street panicked. Pinterest is bleeding ad pricing.
Yeah, it's a structural problem.
It's like, imagine running a museum in New York where the gift shop only sells Yankees hats. But suddenly, 80% of your new foot traffic is tourists from Europe and Asia. You have record-breaking crowds lined up around the block, but nobody wants to buy your hyper-local merchandise, so you end up slashing prices just to clear inventory.
That captures the structural mismatch perfectly. The core bear case outlined in the research is that Pinterest's user growth and their monetization capabilities are, well, they're moving in completely opposite directions. They are expanding very rapidly in international regions, which sounds great for the MAU headline number, but those regions are severely undermonetized compared to their North American base.
Yeah, I want to look at the actual metrics on that because they are honestly alarming. In Q4 of 2025, their global ad pricing actually fell 19% year over year.
19% is a huge drop.
It's massive. And then in Q1 of 2026, it fell another 5%. So they are serving way more ads to more people, but the amount they can charge for those ads is just falling off a cliff.
And it eats right into the bottom line.
Exactly. Because of this, their profitability is razor thin. They have a trailing 12-month net margin of just 7.64%. So despite that massive adjusted earnings beat we just talked about, they posted a GAAP net loss of $47 million for the quarter.
This is where we really have to look at the mechanics of the digital ad auction, because ad prices on platforms like Pinterest aren't set on a static menu. They're determined by real-time bidding.
Meaning advertisers are literally bidding against each other for eyeballs.
Right. And they bid on inventory based on expected return on investment. If you are a European retailer, Pinterest's ad tools haven't historically offered the same pinpoint ROI, tracking that closed-loop attribution as their bigger competitors.
But hold on, I have to push back on the logic here a little bit. If their ad impressions, the sheer volume of eyeballs hitting the platform, are up 41% in Q4 and 24% in Q1, shouldn't the sheer scale of that supply eventually force ad prices up?
You would think so, but no.
I mean, if you have a captive audience of 640 million people, advertisers are eventually going to have to pay a premium to reach them.
Right. If we connect this to the bigger picture, it only works if the ads actually convert into sales. Cheap inventory with zero conversions is still a wasted budget for a brand.
Ah, okay, so eyeballs don't matter if nobody clicks buy.
Exactly. Analysts from Wedbush and Jefferies have pointed out that Pinterest is really struggling to capitalize on these growth initiatives because their direct response ad products just aren't commanding premium pricing globally.
So they're flooding the market with supply, but demand is weak.
Yes. If you flood the market with ad impressions, but bidder demand stays flat because advertisers can't prove a hard ROI, the price per ad collapses. That is the 19% drop. User growth is dramatically outpacing their back-end monetization capability.
Which connects directly to what you are likely seeing in your own industry right now. If you're running a marketing budget today, you demand a hard return on investment. You aren't paying a premium just for, like, brand awareness or good vibes.
No, those days are over.
Right. You need to know that if you spend $1, it generates $3 in sales. Pinterest is failing to deliver that certainty at a global scale. And to fix this massive monetization gap, they basically have to completely overhaul how they serve and track ads.
Which is not cheap.
No, it is not. Which brings us to the $4 billion elephant in the room, artificial intelligence.
Yeah, they definitely recognize the existential threat of this monetization lag, and they are pivoting hard. The research details a staggering multi-year capital commitment. Pinterest just signed a $4 billion cloud services deal with Amazon Web Services, AWS, running all the way through 2031.
$4 billion for a company that literally just posted a $47 million GAAP net loss. That is just, wow.
It is a massive, defining strategic bet. The explicit goal of this AWS infrastructure is to advance their AI projects, specifically a new ad suite they're calling Performance Plus.
Okay, here's where it gets really interesting, because I was reading through the Jefferies analysis in the report, and they raise a point that feels like a slow burn structural risk to Pinterest's entire business model.
Oh, the generative AI threat.
Yes. We are talking about using AI to serve ads, but we really have to talk about what generative AI can do to the core product itself today. Think about the traditional Pinterest user journey. If I want to redesign my living room, I used to go to Pinterest and spend like 3 hours manually pinning different couches, rugs, and paint colors to a digital mood board. It was a very manual discovery phase.
A phase that generated hundreds of ad impressions for Pinterest while you scrolled.
Exactly. I'm seeing ads the whole time. But today, if a generative AI tool can instantly design a photorealistic mood board tailored exactly to my tastes in, like, 10 seconds, the entire manual discovery phase just evaporates.
You don't even need to be on the platform.
Right. I don't need to scroll. I don't need to pin. Jeffries is explicitly questioning the durability of Pinterest's core use case here. If AI-powered search engines or generative design tools can bypass all that manual work, does Pinterest even need to exist in the same way?
This raises an important question. It really is the most critical long-term question for the company. Pinterest's entire economic moat is built on visual discovery and planning. If that moat evaporates, the user base goes with it.
Which is terrifying for investors.
It is. But you have to realize the $4 billion AWS deal isn't about building a generative AI to replace pinning. It's an offensive-defense strategy to fix the monetization lag we just discussed.
So how does throwing billions at Amazon Web Services actually fix the ad pricing problem?
Well, machine learning requires massive, relentless compute power. Pinterest is sitting on a goldmine of consumer intent data. They have billions of boards showing exactly what people want to buy, wear, or build.
Okay, so the data is there.
The data is there, but historically, their legacy algorithms just weren't sophisticated enough to match that raw intent with a specific shoppable ad in real time, especially internationally.
Right, so the AWS investment gives them the muscle to do that.
Yes. It provides the raw processing power to train foundational models that can predict purchasing behavior at an individual user level. That is the performance plus ad suite.
Got it. So they are using AI on the back end to basically guarantee conversions for advertisers.
Yes, exactly. They are processing petabytes of user data in milliseconds to ensure that, when a user sees a mid-century modern lamp, it's not just an inspiring photo. It's highly predictive that the user will click and buy it right then and there.
And if they can prove that.
If they can guarantee that level of conversion, advertisers will gladly bid up the price of the ads, reversing that 19% drop.
But right now, the returns on that $4 billion compute investment are entirely unproven. I mean, management has flat out admitted that 2026 is an quote-unquote investment year.
Which is Wall Street code for lower margins.
Yeah, absolutely. They're dealing with elevated marketing and R&D spending to build this infrastructure. They are basically asking Wall Street to trust the process during an incredibly expensive transition, all while organic revenue growth is noticeably decelerating.
And that tension is exactly what caused the 9% sell-off. The market doesn't want to fund a multi-year construction project, It wants immediate cash flow acceleration.
Which brings us to how the market is actually pricing this reality right now. Let's talk valuation and sentiment. Currently, the stock is trading around $23, which is roughly 41.4% below its 52-week high.
It's taken a beating.
It really has. And on the surface, a 40% discount looks like a screaming bargain. But when you look at the trailing 12-month P/E ratio, Pinterest is trading at roughly 39x. To put that in perspective, the industry average is around 16.5x.
Yeah, so even after a massive haircut, it is still priced like a hyper-growth premium tech stock.
Which is wild given the deceleration.
Exactly. The friction between a premium price tag and decelerating fundamentals is the textbook recipe for volatility. You are essentially paying a premium for a turnaround story that hasn't even materialized yet.
And there's a crucial data point in the research that, honestly, should make anyone pause. We always like to look at what the people inside the house are doing with their own money.
Insider trading activity.
Yes. Over the past 90 days, there has been a net selling of 753,152 shares across 43 different insider sell transactions. Insiders aren't buying the dip, they're taking chips off the table.
Which is telling. I mean, insider selling isn't always a panic signal, but it is definitely a timeline signal.
What do you mean by that?
Well, if the people closest to the product and the financial realities believe the AI ad tools were going to trigger a massive revenue explosion in the next quarter or two, they would hold their shares.
Right, they'd want to ride that wave up.
Exactly. Consistent selling suggests they know 2026 is going to be a long, capital-intensive grind. However, to keep the analysis balanced here, the institutional sentiment on Wall Street isn't entirely bearish.
Oh, for sure. There are definitely bulls out there defending the stock right now.
Yes. While firms like Citigroup and Wedbush are maintaining a strictly neutral stance, you have bulls like UBS maintaining a buy rating and raising their price target to $33.
Yep, so they see a lot of upside.
They do, but the bullish argument is entirely tethered to the AI thesis. If Performance Plus works and they can finally monetize those 640 million users at a North American rate globally, the monetization upside is staggering.
Okay, so if the AI gamble pays off, the current price is a steal.
Right. On a forward-looking basis, if earnings explode upward, a 39x multiple actually compresses very quickly and becomes cheap.
So we just have a total tug of war here. For you listening, if you are trying to figure out how this plays out in the real world, what are the actual fundamental catalysts you should be watching?
The proving ground is going to be the Q3 2026 earnings report this coming November. When those numbers drop, you need to ignore the top-line revenue and dig directly into two specific metrics.
Okay, what's the first one?
First, ad pricing stabilization. You want to see that 19% and 5% drop in global ad pricing narrow to near zero, or ideally turn positive.
Meaning they're finally charging more per ad.
Exactly. That will be the empirical proof that international monetization is finally catching up to the user growth.
So the auction mechanics need to reverse. Advertisers need to actually start bidding against each other again on the platform.
Precisely. And second, you need to look for concrete evidence of revenue attribution from the Performance Plus ad suite. Management needs to stop talking about AI as an abstract concept and start providing specific dollar amounts generated by these new tools.
They have to justify that $4 billion AWS spend.
Exactly. Show us the ROI on the compute power.
So to synthesize all of this, we have a platform with incredible global reach, struggling to make a proportionate amount of money from that reach. They are placing a multi-billion-dollar compute bet on AI to fix their back-end plumbing, all while fighting off the existential threat of generative AI on the front end.
It is a lot of moving parts.
It really is. And they're doing all of this while trading at a massive premium to the market, with insiders quietly selling off shares. It is a highly mixed picture. So what does this all mean for the final verdict from the analysts?
The overall rating provided by the equity research report is a solid 5 out of 10, a definitive neutral. The stance is firmly wait and see.
Which makes sense given the uncertainty.
Yeah. The analysts acknowledge that Pinterest has shown genuine operational progress. I mean, you don't beat adjusted earnings by $40 million without executing strong cost discipline.
But the structural gap is just too wide right now.
Yes. The company simply hasn't proven it can close that monetization lag fast enough. The chasm between user growth and revenue growth is just too deep to justify paying a 39x multiple today. The risk-reward ratio just isn't favorable until the data actually proves that AI ad targeting translates to sustained cash flow.
Which is exactly why this is such a vital case study to keep in mind, whether you're analyzing tech stocks, allocating a marketing budget, or honestly just building a business. Pinterest is the ultimate proof that having hundreds of millions of users, having incredible top-of-funnel foot traffic, does not automatically equal a healthy, highly profitable business model.
No, it really doesn't.
Eyeballs do not equal dollars unless the internal plumbing connects them to an actual transaction.
Scale alone used to be enough to satisfy Wall Street. You just needed user growth. But in the current digital economy, scale without perfectly tuned monetization mechanics is just an expensive liability.
And that leaves us with one final kind of provocative thought for you to mull over as we wrap up today. We talked about how Pinterest is pouring billions into AI algorithms to optimize ad bidding, to push the right shoppable products, and to predict exactly what you want to buy.
Right, maximizing efficiency.
Exactly. But in doing so, do they risk stripping away the organic, human curation that made users love the platform in the first place? If a platform fires its human curators, basically, and replaces them with a predictive algorithm designed solely to maximize ad conversions, is it still a space you actually want to spend your time exploring?
It's a great point. When ruthless efficiency replaces organic discovery, you really risk losing the soul of the product. That is the multi-billion-dollar tightrope they are walking right now.
It's definitely something to think about the next time you find yourself endlessly scrolling. Thank you so much for joining us on this deep dive. As always, keep questioning the numbers behind the headlines, and we'll catch you next time.